Okay, hi everyone. Today we are going to look at cash flow, money coming in, money going out. So now I'm going to assume that you're actually in business to make money, or at least, at the very least, not lose any money. And I'm also going to assume that you're not some Saudi Arabian oil sheik with unlimited amounts of money reserves that keep you afloat. And if so, the reality is you have to know some basics here. So let's have a look at some real basics, and then we'll move on to a few tips and examples. So when we talk about cash, what we mean is the money you have sitting in your bank account in reserve and available to you. That's the money that hasn't been spent yet on wages or inventory, rent, those sorts of things. So cash flow, therefore, is the term that we use to refer to the incoming money that creates that cash reserve, or revenue, and the outgoing money that depletes that cash reserve or costs. So those are the two sides of cash flow, right? The money coming in, the money going out, or revenue and cost. So revenue is generated when you sell something, and costs are incurred when you buy something. But actually that's not exactly true, and this is probably one of the important points to note about cash, right, or about revenue I should say, that revenue is not generated when you sell something. Revenue is generated when you get paid. For some businesses that's the same time. So if you're a news agent, you sell a magazine, you get paid for the magazine over the counter, you've been paid at the same time that you're providing the product. But for other types of businesses, this isn't the same time. If you're a service provider, for example, you might provide a service to your client. Let's say you're an architect, you draw up the drawings, and then when you provide the drawings, you also provide an invoice. And that invoice might have 14-day payment terms, 30-day payment terms, and that's the length of time that person needs to wait to get paid. That business needs to wait for the money to come back. So really, that is a weaker position to be in than the business that's getting paid at the point at which they're providing the service or the product. So really, I think you want to be aiming for getting paid up front whenever possible. And if that isn't possible, you want to be looking for ways to minimize how long you have to wait. So here's some tips for getting paid quickly. First one, as I said, is getting paid up front. Or at the very least getting a deposit, particularly for things that are going to take, going to be delivered in a number of stages or over a number of weeks or days. You want to at least have some upfront payment to help you get going. You want to invoice those projects and services in stages, those things that you deliver over time. Make sure you have installment invoices going out as you move through the delivery of those products or services. Also, some businesses wait to the end of the month and they do one run of all invoices and then send out those invoices to all their clients. But, if those clients were actually at the point of completion, or you completed delivery of the product or service to them at the start of a month, you've already waited 30 days by that point. Then sending them an invoice with another 30 days for payment means that you're 60 days behind getting paid already. So you want to get on top of this. You want to be invoicing your clients, your customers, as soon as they owe you money, basically. And when you invoice, think about providing an incentive. And I've seen this work well in a number of industries. So consider offering a 2% discount, for example, if the invoice is paid before the due date. Then what you want to do is weigh up the costs of providing that discount against the time and the cost that you have to sort of put in, the effort you have to put in to chase invoices, and work out whether that's a good option for you. Also have a look at your invoices and make sure that it's easy to see the bank account details, the payment terms. Have a look also at whether you want to include credit card or PayPal payment options for smaller invoices or less frequent customers. You really just want to make things really easy. And you always want to follow up a phone call. You always want to make a follow-up phone call, I should say, when you send an invoice. Don't just mail or email an invoice and then hope that it gets paid. You want to follow it up. And research shows that phone calls, follow-up phone calls on invoices really do help in the speed of payment and also in the rate of payment of coming back in. You can also use that phone call to make sure you've sent the invoice to the right person and you don't have unnecessary delays in reissuing an invoice to the right person down the track. Look, you're always just about every business will have late payers, and you need to make a decision on how to deal with it. You can either pull out the big guns, lawyers and debt agencies and those sort of things. Maybe in some cases they are the right option for you. But I think at least to start with, you want to try and work with late payers. Think about how you can schedule in some sort of a payment schedule, and try to get some money back, because some is better than none at the end of the day. And then ongoing, you want to try and maintain a clean roster. And by that I mean you want to be able to credit check new clients coming in, make sure there's no issues, and where there are issues and you still wish to work with that client, get them to pay you up front. Okay, let's look at another common misunderstanding, I think would be the word out there, in that you can be running a profitable business and still run out of money. All right. So many business owners assume that if they are profitable, they don't have any financial problems. So they make the mistake sometimes of asking their accountant, am I making a profit? And if the answer is yes, that's pretty much all they worry about, right? They don't ask any other questions. And really at first glance, it almost doesn't sound quite right, because most people consider, if I'm making a profit, well, that obviously has to mean that I'm making more money than I'm spending. So, if that's the case, how can I be running out of money? So let's look at this diagram as an example of why that would be. So each column here represents 1 month in the year. So the blue sections are revenue, the red sections are costs. And this is a pretty classic model of a retail business, because most retail businesses make most of their money, most of their revenue, in the months leading into Christmas, and then that sale period in January that follows Christmas. So let's say, for example, and just for argument's sake, that the total revenue earned for the year is $100. The total costs incurred during the year were $90. Okay, so those costs would be things like rent and inventory, staff, insurance, and those sorts of things. So if we just take this at a very simple level, it's $100 less $90, so that would be a $10 profit for the year. But so, if that business is profitable, what's the problem? And what I've done here is circled the problem. Because this is a retail business, it needs to stock its inventory for the Christmas period in August and September, and that's when it needs to pay for that inventory. So in order for the business to stay afloat in August, September and October, it needs cash in the bank, because its revenue in those months is not increased, only its costs. So unless they keep the majority of the revenue they made during the previous Christmas period, then they could easily not have enough money in the bank to buy the stock that they need for the period ahead. Now, in different businesses in different markets, we have different cycles and costs and revenue, but for all industries, there are typically peaks and troughs in any year, and that's what causes cash flow issues. There's a very common trap here that particularly, I think, applies to new business owners, that you want to make sure that you're understanding the costs that are coming up ahead, and also how that marries up, if you like, to the revenue that you're going to bring in. So the second rule here is that profitable businesses can still go bust because of a lack of cash in the bank. That's why it's really important that you understand how cash flow works, or at least have someone in your business, not just an accountant externally, but someone in your business who's looking at this and thinking about this, make it their role. Now, you've all heard the high failure rates of new businesses, like 70-80% in some cases. But what you might not know is that at least half of these businesses failed not because of increased costs, but because of increased sales. And that, again, let's just think about that again. So half of the businesses that fail do so because of growth. And what they do is they start to grow rapidly, and because of that their costs increase. But because of a lag between when they have to spend the money on those costs and when they realize the revenue from the sales, they run out of cash in the bank to stay liquid, and then they go bust. So let's look at some ways to manage cost. The first one is to negotiate favorable terms with suppliers. And I think this is a really key one, because you want to try and set up an ecosystem, if you like, where you are paying as late as possible the bills that you owe, but making your clients and customers pay the money that they owe to you in a shorter time frame as possible. And in that way, you set up an environment where you have the best chance of managing cash flow through each month, each cycle. Inventory is a big weight on most people's cash reserves, so it's really important that you understand how much inventory you have, how much money that's costing you, whether it's necessary to be holding that much inventory, and figuring out ways to reduce the amount of inventory you need to hold at any one time. Also consider leasing. Leasing can have tax advantages, potentially. It can also reduce the amount of capital that you need to put into buying things like, your IT systems, your comms and point of sale, machines and those sorts of things. So you really want to consider the benefits, not just the additional costs of the interest, but also the business benefits of leasing. Outsourcing can be an option. You can pretty much outsource any part of your business if you wanted to. Marketing and finance and HR and those sorts of things can be outsourced, but you need to obviously work out how much of, what level of control you're willing to put outside of the walls of your business, if you like, and how much of it you want to keep within the walls of your business. But flexibility can be gained through outsourcing, and by that I mean the ability to spend cash or not to have to spend cash as you would if you had a full-time employee where you have to pay those wages. Okay, the tax department, always a favorite, but in my experience it's always better to work with the taxman than against the taxman. They're much more likely to want to work with you to get you over troubling periods where you can't or have to miss a tax payment deadline, and put in place payment schedules if you're proactive and open and honest. That's usually and virtually always the best path for you to take in regards to tax departments. And same with the bank. You want to have an ongoing good relationship with the bank. You want to be proactive in your relationship with the bank, and you want to have lines of credit and overdraft facilities set up ahead of any urgent need to use them, right? Because nothing sends off alarm bells at the bank more than a business person running in and requiring an immediate urgent overdraft because they've run into some issues. And really, don't be afraid to ask questions. And many people let their ego get in the way in some ways, right, of asking questions. You're hiring professionals to do certain things. Ask questions. You want to learn. You want to know how your business is performing in all aspects. So don't be afraid to ask those questions. Too many business people don't ask those questions and get into trouble because they didn't ask those questions. So let's bring this all together. How do you successfully stay on top of costs, revenue, and cash? How do you, see the future, predict the future, and figure out what potential issues are coming before they come, so you can deal with them now? Well, the magic tool, if you want to call it that, is a cash flow forecast. And don't be scared. It's something really that everyone can do. Yes, accountants use them, but they're not exclusively for accountants, because at the end of the day, they're really just measuring all the costs that you have, then all the revenue that you're going to bring in, and describing how much money in the bank you will have each month with all those things taken into consideration. It's really important that you have a cash flow forecast running at any time for your business, and that you update it every month so that you can see ahead and predict the future, essentially. So I'm going to leave it there, but I want to really ask you if this was a useful content, what you liked, what you would like to know more about. So take a moment, complete the comment sections underneath here, leave a comment, tell me what you liked, tell me what you'd like to see more of. And I will take those comments on board as we deliver more content, hopefully really valuable content over the next few weeks. So thanks again.